Perspective now on these markets and valuations. We're going to speak with Rob Tetrault. Rob Tetrault is Senior Portfolio Manager and Vice President at the Tetrault Wealth Advisory Group, Canaccord Genuity. He joins us from Winnipeg. Rob, good morning, and thanks a great deal for joining us. Investors have been through a lot this year. They've seen their stocks fall off a cliff in March. Then they have watched those stocks soar back, in some cases, to new record highs. What is your thought on broad market valuations right now?
Yeah, 2020 is definitely a lesson in why you want to remain invested, is it not? I mean, quantitative easing and everything we're seeing on the spending side from the government is clearly fueling all of this because, as many pundits and experts have said, the kind of economic macro indicators shouldn't probably reflect all-time highs or near all-time highs for some indices. So valuations, we think, are clearly being propelled by government spending. The government has said over and over they're not going to stop. They're going to continue to spend. It's a blank check. They've used words that they've never, ever used to kind of demonstrate what they will do with dollars, with funding, with the retail client, the retail Canadian, the investor. So there's just a lot of backing there. So we do think in the next 8 to 12 months, we're going to continue to see all-time highs on the S&P 500, and the TSX will continue to push towards that with respect to valuations.
What does this mean to your client portfolios? How are they composed right now?
Well, so for us, we've always been, on the equity side, we've always been overweight U.S. And global, specifically U.S. Back in January, we were extremely fearful, I'll say, of valuations. I didn't know a pandemic was coming. I had no idea COVID was coming. But regardless, we took a little bit off the table in January, February, and then we re-put that in. We're largely, we're fully invested. We're kind of rotating out right now. So if on the equity side, we're overweight U.S., global, underweight Canada, and then we also have, we have fixed income, traditional fixed income. We have alternatives, private REITs, private debt, whatever that may be. We do believe there are 3 asset classes, not just 2 asset classes, like most portfolio managers would. So cash and fixed income, your equity, and your alternatives. And depending on the risk tolerance, but we're fully invested, Paul, and we believe that you got to be invested. The opportunity cost is too high not to be invested.
What have you done as the market has risen through April, May, June, and July? What type of moves have you made since the bottom?
So the great thing is we were kind of spot on in calling the top, which was fun when you do. It's great. It feels so good. But it's hard to, as you know, and as all portfolio managers know, to pick the exact bottom. So we were a little slow to put the cash back into the market. We never thought we'd see the biggest bounce back in the history of bounce backs. So we're a little late to put that in, but we're still pleased with how that trade went, because obviously if you're pulling equity off the table in January and putting back in April, you've done well. So we played it. We added. Our technical names now, our technical indicators now are telling us to kind of do some sector rotating out of U.S. growth and into either global value or even some Canadian value. So that's kind of what we're looking at doing now, what we've been doing lately. But we've kind of been enjoying the run, Paul. It's been fantastic here these last 4 months.
Tell us more about that move into global securities versus and somewhat away from your earlier outsized position in U.S. securities.
Well, we've made so much money in the U.S. and we think the valuations, just straight up valuations being stretched. So if you've made a ton of money in growth plays in the last while, you're one of those investors that has had, all the tech names, all the healthcare names, and you've just done really, really, really well. Might be time for you now to start considering, this is the equivalent of rebalancing, if you will, and rebalancing into, value. Some Canadian financials, for example, they're completely forgotten right now. Some of them are trading at 10, 20% discounts to historical multiples. They're 8.5 NAVs. Some of the life cos, some of the asset managers are trading at 8.5 PEs. So when you're seeing that, it could be just a healthy play. So if you're dramatically overweight now in growth, which you probably are if you've been pounding into those names because they've appreciated so much, we would think you should take a look at some value. And globally, the move is simple, Paul. Globally, ex-US, we're seeing multiples for some of these large, and and these companies, these large multinational companies, whether they're in the U.S. or they're on a global exchange, they have their tentacles pretty much everywhere. So you're getting truly global exposure in the U.S. companies or in the global companies. So if you're going to be into a global company, some European companies, some Far East companies, or some Australian companies, they're just trading at way better multiples. So it's just a value play, a rotation play that I think prudent portfolio managers are likely doing right now.
The rally in gold has been very, very dramatic. Have you given your investors or your clients exposure to gold?
Yeah, I hate to say it because I've been the guy that forever has been saying I will never own gold. I will own gold when it pays a dividend. So we're not bullion. I'm not a bullion buyer at all by any stretch. But we cannot ignore companies that are profitable, that are trading, and that are part of the sector and part of the index. We've been underweight gold since forever. And earlier this year, we finally started adding some gold names, and they've done well. And we don't want to be overweight gold by any stretch, but we're definitely market weight right now, sector, and some of these names, the sector itself, you look at where gold was in 2011, the last time it hit its all-time high, I think it was mid-2011 or something like that. It was on fear. It was on fear of, a similar situation than now. The gold stocks were trading much higher than they are now relative, and now we're hitting $1,900 an ounce here. This last $600 an ounce that we've added over the last while here, you and I know how that works. It's largely straight to the bottom line. So we expect to see the earnings. We expect to see earnings beat, and that's why we want to be in the sector right now.
Why don't we finish with the banking sector? What is your view of Canadian bank stocks, U.S. bank stocks at a time, obviously, when economies are facing big challenges, although they may be growing at accelerated paces off those bottoms, and interest rates are seen as being very low for a very long period of time?
Yeah, that's a good question. And just the last point I want to say on the gold thing, expect to see some flow-through activity for the first time in a while. We're seeing a lot of flow-through activity in the junior gold sector, which is very interesting. On the banking side, I would prefer other financials than banks right now in Canada. They're just trading at slightly better multiples. U.S. banks, you have to remember that it's not like in Canada with the U.S. banks. So it's not the same thing. Although there are 6 kind of mega banks, just like in Canada, it's not quite the same thing. You have dividend cuts. You have different rules, like Wells Fargo, as we've been following it. It's just been a dog. There's definitely opportunity in the banking sector because it is so out of favor right now in the U.S. My preference in Canada would be to take a look, as I mentioned, Lifecos and other financials. I think there's tremendous opportunity there. I know it's a boring play. If the viewers are out there, why would I want to own, Amazon's doubled in 4 months. Why would I want to own, Canadian Lifeco? It's just prudent sector rebalancing. If you're probably overweight those stocks, now would be a great time to rotate out of them.
Rob Tetrault, thanks a great deal for your insight. Rob Tetrault joined us from Winnipeg, where he is Senior VP and Portfolio Manager and Head of the Tetrault Wealth Advisory Group at Canaccord Genuity. Thanks.